In the last episode, we exposed the hidden leverage inside modern banking, a system built on debt, confidence, and the fragile hope that depositors will never all ask for their money at once. But what happens when that hope collapses? Most people imagine a crisis the old-fashioned way, like 2008. Governments rushing in, taxpayers footing the bill, deposits protected at any cost. That was the era of bailouts. Private losses were socialized, public debt exploded, and inflation simmered beneath the surface. But after the dust settled, something changed. Quietly, legally, globally. A new doctrine was written into law, a reversal of the 2008 playbook, one designed to protect governments and shift the burden somewhere else. It's called a bail-in. And unlike a bailout, where money flows into a failing bank, a bail-in reaches inside the bank, using the funds already there to absorb the losses. Your funds. Few people realize this, but in modern banking law, your deposit is not treated as your money. It is a liability on the bank's balance sheet, a liability that can be legally frozen, written down, or converted into bank shares in a moment of crisis. And all of this can happen while the bank stays open. No queues around the block, no shuttered doors, no dramatic collapse, just a silent internal restructuring, with savers, not taxpayers, absorbing the impact. This system, mandated by the Financial Stability Board and woven into the laws of nearly every major economy, gives regulators extraordinary powers to sacrifice deposits to save the institution. Because in the hierarchy of creditors, you are one of them. If fractional reserve banking was the hidden leverage we uncovered in episode 4, bail-ins are the hidden risk. In this episode, we will expose how bail-ins actually work, where they've already been tested, and what really happens to your money when confidence cracks. Let Ian share his research.
After the 2008 crisis and the bailouts trillions handed out to rescue banks worldwide instead of bailing out the people, it felt profoundly wrong to my friend and me. It felt totally rigged. Following our deep dive into credit creation banking in the last episode, we couldn't stop asking, how did they prevent this taxpayer bailout chaos from ever happening again? That question sent us down another darker rabbit hole. Continuing with our mastermind approach, we spent months poring over every piece of obscure financial legislation, academic paper, and G20 communique we could find, determined to understand the new rules of the game. We weren't looking for a quick fix, we were looking for the architecture of the new system. That's when we stumbled upon the Financial Stability Board, or FSB. It was created by the 2009 G20 meeting. It sounded bureaucratic, meaningless, a talking shop. But the more I dug, the more I realized it wasn't a bank or a government. It was the architect of the new system. It was the global body that created the law that changed everything. Systemic warning. By 2012, massive UK, US, and Eurozone debt confirmed the system's precarious leverage. The 20 most powerful nations weren't going to stop banks from failing. They were just changing who takes the fall. And the name of the new game? Bank bail-ins. The Financial Stability Board, FSB's mission was to end the too big to fail, TBTF problem, which from my perspective was essentially a problem of economic blackmail that the FSB softly labeled as moral hazard. Indeed, post-2008, some banks were identified as TBTF. To use the FSB's technical jargon, these institutions became known as Global Systemically Important Banks, or GSIBs. During our research, we discovered the financial system had grown monstrous. A bank like Anglo-Irish Bank, AIB, for instance, had assets 6 times the size of Ireland's entire GDP. And it wasn't the only one. Quite a few banks became so enormous that it became unthinkable for governments to allow them to collapse. Governments faced two impossible choices. A, let these big banks fail and risk the entire global economy collapsing, or B, use taxpayer money, public funds, to rescue these failing institutions, which had indulged in risky financial instruments, what Warren Buffett famously called weapons of financial mass destruction. The bottom line is we stepped into a catastrophic scenario where banks could no longer trust each other, but some were just too big to be allowed to fail. So, the governance choice was option B, the bailout, which we mentioned briefly at the end of episode 4. Indeed, by choosing option B, governments rushed in with massive taxpayer-backed funds. This swift, unified action protected depositors and stabilized the TBTFs. On paper, no citizen lost their savings or deposits. However, this decision came at a tremendous cost. The risk from private sector failures was successfully transferred to the public balance sheet, drastically increasing government debt and creating the structural conditions for the slow economic recovery that followed. More importantly, their action cemented the systemic danger, the moral hazard, that the FSB was tasked with resolving, because the banks and their creditors knew that when their excessive risks turned toxic, the public, not them, would ultimately bear the cost, incentivizing the same kind of reckless behavior in the future. The reason why it felt like my friend and I had followed yet another darker rabbit hole is because the FSB was tasked to prevent that taxpayer bailout from happening again. They came up with their main doctrine, the key attributes of effective resolution regimes. The document was drier than toast, but the implications hit me like a cold wave. The plan wasn't to stop banks from failing, it was to change who pays when they do. We, the people, again. Indeed, the new rule cooked up by the FSB is that when the big bank fails in the future, the investors and creditors of the bank must pay the cost of the cleanup, not the taxpayers. But here's the kicker. When you remember that taxpayers are also creditors of the bank, something we laid out in episode 2, essentially we, the people, will still be on the hook when the next global financial crisis strikes. And most people don't realize these laws are already in place, just waiting for the governments to apply them and for the media to sell this to us as inevitable.
Welcome back. This is episode 5 of our 10-part series, Your Money in the Bank Isn't Yours. We're halfway through the truth. If you missed episodes 1 to 4, don't worry. The links are in the description, or they might be popping up on the screen right now. Watching them will give you the essential context on credit creation banking, but you can dive into this episode about bank bail-ins without missing a beat. Here's the deal. The more engagement these videos get, the faster we can release the rest of the series. Every like, share, and comment helps us move forward and build this community. And of course, with each episode, we reveal one of the 10 essential books that shaped our approach to financial independence. These aren't just theory, they're frameworks used by people who actually built wealth in the real world. In our last episode, episode 4, our book pick was Your Money or Your Life by Vicky Robin and Joe Dominguez. It's the foundational guide that helps you calculate what your life is truly worth. Stick with us until the end. Later in this episode, we'll reveal the game-changing book that inspired our deep dive into the surprisingly simple, often hidden habits of real-world millionaires. So hit like and subscribe, and let's get back to the architecture of the bank bail-ins.
So the FSB completely flipped the script. They weren't going to use taxpayer money again. Instead, they were going to use the bank's liabilities. And who is a bank's biggest, most reliable liability? The bank depositors. Specifically, uninsured depositors and bondholders. Ian continues with his experience.
That's when I finally understood. The global elites hadn't solved the problem of bank failure. I mean the root causes such as credit creation, debt-based banking, the hidden leverage, financial derivatives, and shadow banking systems. No, the elites wanted to keep these networks of financial mass destruction pretty much intact, but they put in place new rules, the bail-in framework that forces the creditors to become the ultimate insurer. This is the hidden risk. Uninsured bank deposits and other bank debts are no longer just liabilities to be paid. They are now potential loss-absorbing capacity, TLAC. You see, that is the hidden systemic risk of the financial system. It's yet another reason why, beyond the insured limit, your money in the bank isn't entirely yours. The FSB framework was complete. Now, every major economy had to implement it. This isn't a theory, it is now the law of the land, hidden in plain sight.
Essentially, the global standard established a clear bail-in hierarchy. This hierarchy dictates exactly who pays first when a bank crashes. First, the shareholders. They get wiped out completely. They lose everything. Next are the junior creditors. These are investors holding risky debt. They absorb the next wave of losses. Then come the senior creditors. This group includes bondholders and, critically, your uninsured deposits. They are the last major line of defense to take a hit. But don't panic completely. Your insured deposits, typically up to $250,000 or 100,000 euros, are protected by law and are the very last thing to be touched. The goal? To ensure the bank has enough internal total loss absorbing capacity, TLAC, to be resolved quickly and smoothly without spending a single cent of public money. Ian and his friend have diligently researched the specific legislation for various major countries. If you want to know which bail-in laws apply to your country, just ask in the comments section below. We'll reply as soon as possible. Now, let Ian continue.
Based on my research, the pattern is identical across the G20. The law is written, the system is in place, and the public is unknowingly lined up to absorb the shock of the next global crisis. The bail-in framework may seem like a theoretical plan, a dusty document in a government vault, but make no mistake, it has already been tested in the real world. In March 2013, the tiny island nation of Cyprus provided the world with the real-time blueprint of how a modern bank resolution is executed and who truly pays the price. Cyprus's banking sector was enormous, 8 times the size of its entire economy. When its 2 largest banks failed, the European Union and the IMF demanded a resolution that avoided a taxpayer-funded bailout. Their solution was a bail-in. At the Bank of Cyprus and Laiki Bank, the government imposed a radical solution. Insured deposits, accounts under the guaranteed limit of $100,000 were protected. Uninsured deposits, accounts over $100,000 were seized and converted into bank equity. At the Bank of Cyprus, large depositors lost 47.5% of their funds above the insured limit. At the even more troubled Laiki Bank, the losses were total. It was simply closed down, and uninsured depositors lost nearly 100% of their savings. This was not a slow, bureaucratic liquidation. This was a lightning-fast digital amputation. Within days, actually over a single weekend, millions of euros were wiped out of accounts belonging to businesses, pensioners, and international investors. Their money wasn't just lost, it was seized and used to save the institution. So, Cyprus was in fact a proof of concept. It proved that in the digital age, the bail-in can be executed before the public even has time to realize what's happening. The global message from the Financial Stability Board was clear. The system of private losses becoming public debt was over. From this point forward, the bank's own creditors, including the largest depositors, would become the primary source of recapitalization. The bail-in law was no longer a theory. It became a precedent with Cyprus. And if it could happen to depositors in a European country in 2013, it can happen anywhere.
The post-2008 bank bail-in doctrine, strengthened by the FSB framework, is among the most extraordinary financial powers ever written into law. Rather than the G20 and FSB seeking to prevent banks from taking extraordinary risks with depositors' and creditors' money, they simply sought to protect governments from further liabilities. While these laws are designed to stop risk from spreading through the global system, it leaves one massive question unanswered. Why didn't the authorities just stop the banks from speculating in high-risk financial derivatives in the first place? By enshrining these choices into law across the G20, governments have fundamentally altered the global financial architecture. We have moved into a system where safety no longer comes from the inherent strength of a bank's decisions, but instead from the broad discretionary authority of regulators to seize and convert your hard-earned money to prevent a collapse. In the end, the authorities made a choice. They chose to protect the speculators and the global megabanks over the property rights of individuals and successful businesses. This risk is no longer a what-if. It is embedded in the law. It is a hidden architecture of seizure, hidden behind a carefully maintained facade of security. Our goal with this video was not to instill fear, it was to provide clarity. It's about seeing the system for what it truly is, and reclaiming control of your financial future, rather than outsourcing your security to authorities who have built a framework designed to prioritize the institution over the individual. If you found this valuable, share this video with anyone you believe is seeking true financial protection. Let's not forget, the same governments and central banks that claim to protect your deposits are the very same institutions that expand the money supply and devalue the currency. This silent erosion of monetary value is another massive threat, not just to your wealth, but to your entire livelihood. In the next episode, we uncover the truth behind currency collapse, how inflation works, how central banks weaponize it, and why every pound, dollar, or euro you hold is engineered to quietly lose its power. But for now, we leave you with this: The Millionaire Next Door. This book asks a simple question. What does real, durable wealth look like in a system built on debt, leverage, and now, bail-ins? Its lessons are a blueprint for financial independence: frugality over flash, net worth over status, and discipline over speculation. It is a manual for building the kind of wealth that can survive and even thrive outside the vulnerabilities of the modern financial system. Subscribe and share it with someone you trust. In the next episode, we expose the mechanics of currency collapse and the strategies that help you step outside the illusion of stability the system sells.